welcome to our webinar on the inheritance tax trap. We are here today to make absolutely sure you don't get completely stuffed over by HMRC taking a £1 million bite out of your assets. I'm Ross, I'm the chairman of Hive Business, and we act for about 400 dentists across the UK. Before we get into the content of the webinar, I just want to go through a couple of housekeeping elements, if that's okay. All tax and financial advice you hear in this presentation is for illustration only. It's not investment advice, it's not tax advice, and it's not tailored to your specific circumstances. So, as I said, I'm Ross, I'm the chairman of Hive Business. What I think is very key for everyone to understand is it's our philosophy and approach to advice that we get the absolute best outcome for our clients. So we only work for dentists, and that is critical because we have set Hive up along with our professional partners to make sure you get dovetailed advice that kind of interlinks together that gets you the best outcome. That is absolutely crucial in the world we operate in now. It's way more complex. There is significant overlap between different streams of what you're undertaking. So it is absolutely key to us. So I'm also very pleased to welcome our tax director at Hive Business. So Simon, welcome. And also very pleased to welcome David Abel, who is our independent financial advisor at Vision Dental Wealth. And we've been working with David for several years now on situations exactly like we're going to cover off tonight in terms of wealth planning and financial planning for our dentists. So I want to just pause and reflect for a moment, because actually HMRC's strategy with inheritance tax is absolutely genius. So what we're at is at the intersection of decades of financial inflation. Quantitative easing is more recent kind of term they've thrown over it, but that for decades has lifted asset prices, whether that's stocks and shares, whether that's property. We've all kind of seen what's happened throughout the years with asset prices, but we then got fiscal drag as well, kind of holding back the tax-free thresholds that are in place. So today we're going to be particularly talking about the inheritance tax-free threshold. What we've also got, which I think is the most genius part about what HMRC have undertaken, and I think they're going to significantly kind of push more on this across other taxes as we move forward, but they are capturing they're capturing using their behavioural nudge unit. I'm absolutely convinced that they're behind some of the policies that are coming out here. Is they're using what's known as the pain of paying. So unfortunately, in a situation where with inheritance tax, it's actually not the person who has generated the wealth that ends up paying the inheritance tax bill. So detaching that is creating this kind of intersection between increased asset prices, suppressed tax-free thresholds, and also very practically and behaviourally, slightly less motivation to resolve this, because ultimately the person who writes out the check is not actually the person who's generated the wealth over the decades. So I have to give kind of credit to HMRC in that sense, but I am absolutely not happy about that scenario. And what we're here today with Simon and David is to help kind of spotlight and highlight this situation. So your hard-earned assets, your hard-earned cash, your hard-earned investments, which you've saved hard for over the years, are not under significant threat. So if I give you an example as to how obscene this situation is, and how quite easily an average dentist can be exposed to this scenario. Imagine a £1 million house, for argument's sake. It's not unreasonable to have your primary residence being worth £1 million. You might have saved with your spouse sort of maybe 500k each, so £1 million of pension over the years and decades. Maybe you've accumulated a couple of buy-to-let properties as well, let's say 250k each, so 500k of properties. We've also accumulated £1 million of other investments, perhaps some ISAs, some stocks, some shares, classic car. We've got £3.5 million worth of assets. We've only got £1 million worth of tax-free allowance, which is totally consumed by your private residence. And your potential inheritance tax bill there is seven figures at £1 million. That is a scenario which I don't think is completely unrealistic for probably every dentist in the UK. And therefore, I am not happy that the HMRC can potentially take £1 million worth of that away. So how do we attend to this? Well, it's great that you've chosen to turn up today or to watch a recording this webinar. That is the first step, and it's a very important first step. Now, I don't want to kind of oversimplify this because HMRC have done an absolutely fantastic job, combining a set of circumstances, which it basically is a bit difficult to kind of navigate. So the best way to get through this is going to require your three experts working in a room together at the same point in time to get you the best outcome. Now, I'm absolutely confident you can get a better outcome than £1 million worth of inheritance tax, but this is the bit I kind of can't underestimate. You are going to have to be motivated to resolve it, and you will have to get experts in the same room at the same point in time. Otherwise, there'll be kind of little loopholes and nooks and crannies where, you can lose 5-6 figures kind of quite easily. So your tax expert and your accountant have got to, appraise your situation. We've got to work together with the financial planner to make sure that, your income requirements are covered off and any countermeasures are deployed. A solicitor plays the same role in the process as well, because there'll be legal requirements to perhaps execute whatever it might be, structures or wills and powers of attorney that help you kind of navigate your way through that. So what we're going to go through today is a little bit of a tax background on inheritance tax, a particular focus on the £2 million trap as well, which will become a little bit clearer once we get there. And we're also going to talk about the very important pension changes that are kicking in from April 2027. So I gave you an example earlier about an example estate that someone might have with their £1 million house, their pension savings, their buy-to-let savings, some other investments. The gestation, I suppose, for this webinar started with the pension rule changes, but actually there's a deeper meaning behind it, which is decades of inflation and asset price increases, and behavioral change in terms of how essentially more people are wealthier and more exposed to that inheritance tax. So we're really going to try and attack that today and in a follow-up webinar. And just as a little statistic probably to help example this, so the last available data for inheritance tax was in the 23-24 tax year, and the average amount of inheritance tax paid was 230k at that point in time. I believe that's going to, probably fourfold or fivefold as an average, because there's just less attention on inheritance tax, ironically. We want to change that. We want to show how you can deal with the horrific changes that they've made to pensions, drawing them into taxable estates. We're here today to help make sure you don't really mess it up, and don't really mess it up to the tune of 7 figures. So I'm pleased to hand over to my tax director, Simon. Simon, if you can give people a little bit of a background to help give a little bit more colour on the situation.
Thanks, Ross. Hi, everybody. Thanks for joining us tonight. Yeah, so a lot of this will make a lot more sense once we've covered some of the basics, and I'm assuming a lot of people watching this will know the very high level basics, but I just want to make sure no one's making any assumptions about what any of this means and how it works. So what is inheritance tax? So broadly speaking, this is a tax on your estate. So the assets that you own at the time you pass away, the government want their slice up. That could be property, could be your house, could be cash, soon going to be some pensions that you might have, just other possessions you might own, but it's the value of those at the point you die, and actually even potentially some of the things you might have gifted before you've died, which we will cover bit more in a moment as well. Inheritance tax in the UK applies to UK assets, but actually for people who are UK domiciled, and this is something that is always on the government's radar, because there's so many people moving abroad to try and avoid this to jurisdictions that don't have the same inheritance tax rules. Actually, UK domiciled individuals are subject to IHT on their worldwide assets as well. And what is it? Well, headline figure is it's a 40% tax, but there's a little asterisk there, as we'll cover as we move through things. There's times where it's 60% and even higher due to some other taxes that kick in, just helping it get paid, broadly speaking. So if we think, actually, I might be a bit exposed to inheritance tax here, I don't like the idea of that, what can we do about it? In broad strokes, the main thing, the main tool you have available to you is to give your assets away. There's lots of caveats to that, there's lots of rules to that. Obviously, the government don't want it to be as simple as just handing everything away the day before someone passes away when they know they're ill, for example. So we've got lots of rules that have been built over the years to prevent that from being the way it can work. So the first thing you might all be familiar with within the world of inheritance tax is the 7-year rule. So again, there's complexity to it, but you've got to be giving things away in advance of dying. There's no deathbed tax planning available here anymore. So the sooner you gift assets away, you then survive 7 years, that's when they become exempt from inheritance tax. If anything happens in the meantime, then there's a bit of a sliding scale as to how much tax gets paid. But broadly speaking, you need to be planning this. You need to give yourself some time. And also some of the allowances we set every 7 years as well. So actually, with enough planning, you can give away multiple slices of wealth over 7, 14, 21 years, which can be a really effective way of reducing inheritance tax. But it is important that you're not falsely gifting your assets away. You have to actually give them away. The classic example is to give away the house to the kids. So I don't own this anymore, or can I just live there, please, tax-free, rent-free, for example, and that doesn't work. You haven't given that away. You've still got access to that asset. You're still able to use that asset. It might not be your house, it might be shares in a limited company as well. But if you've still got control of and use of that asset, you've not really given it away in the eyes of inheritance tax rules, and there will be still counted in your estate. There are
probably the thing I say, Simon, as well, is it's not the thing you want to kind of toy with either as well, because you get it wrong and it's a 40% wallop.
Yeah, it's not a case of this might be some of it might be in, some of it might be out. If you've got access to those assets, the full value of them will be in your estate, and the numbers, particularly on a house, will be quite big. So yeah, you've got to get that right. There are some reliefs available. Ross has mentioned them already with kind of the nil rates and fiscal drag and all of that. But actually, the main relief that everyone probably takes for granted is a spousal exemption. So anything left to your spouse is just outside of the scope of inheritance tax. It's just not caught at all. And some of the other reliefs actually get passed to your spouse as well. So if you die leaving everything to your spouse, not using up, therefore, your own nil rate band, your nil rate band will also pass to your spouse. So what is the nil rate band? It's currently £325,000 of asset value per person that is not caught by inheritance tax. And this is where this interacts with the 7-year rule as well, because you can, I won't explain it completely, the mechanics, but broadly speaking, 325k can be given away every 7 years without triggering any inheritance taxes. But that is going back to something Ross said earlier, that is a number that has been set and frozen for many years. Assets have grown in value a lot since that was 325k. I think it was originally conceived to cover the family home. It's kind of not really enough anymore. The family home is often worth more than that, with business assets on top, investments, soon to be pensions. It's just not covering much of many people's assets anymore.
I think it was publicised today that Ricky Gervais has married his wife or his longtime partner as well. So not that we kind of tell people to get married or anything like that, but it he's been quite upfront about it and said it is for tax planning.
Yeah, Along with
I've
that,
said it's worth exploring to a few clients.
yeah, there's other areas of tax as well where there's benefits to being married, but you've got to do that for the right reasons. Nil rate band, so it's not enough anymore. As a way to kind of counter that fiscal drag, we now have the new, I say new, it's been around for a few years now, but it's much newer than the nil rate band. We have the residence nil rate band, which is an extra 175k per person, which is where, £1 million covered by the house. That's where that comes from. 325, 175, two people. That's £1 million of exemption against the family house, roughly speaking, if it's left to your descendants. So that covers, actually, that probably does cover way more than 325 used to, but there's conditions with that. And part of the trap, which I will explain in a moment, because that's not fixed, that can be taken away from you as well. Another relief people will be familiar with perhaps is business property relief. So if your estate involves a business, actually the government don't really want to break up a business to get some IHT paid. So businesses are exempt from inheritance tax as well. Now that used to be an unlimited relief. So it came in last April that's now capped at £2.5 million per person, 100% relief, 50% relief for anything above that. But there is still relief for businesses. There's also a separate relief for agricultural property, but we're not going to cover that. But it will be something people are familiar with from the news about a year ago, maybe 18 months ago now, actually, when that first got announced. And what we also
the only thing sorry, Simon. I think the only thing I would say is it was quite common planning for wealthy individuals, and I, appreciate viewers might not kind of think they're wealthy as such, but it was fairly common for wealthy individuals to perhaps reallocate their assets into business and certainly into agricultural property to make sure they were protected against that 40% IHT bill.
Yeah, lots of farmland bought up by people from the city to qualify for relief and not have their estate taxed quite so much.
Maybe make a TV program about it as well at the same time.
Yeah, maybe. We've also got small gifts and exemptions. So there's quite a few different things, but broadly you can give away 3k a year without really having to worry about it. Kind of designed to mean that Christmas presents, birthday presents aren't really caught. There's extra rules for gifts on marriage and things like that. And the one that's actually not mentioned here is regular gifts out of your income. So if you're giving away what is excess income and not actually diminishing your capital, you've not given anything away in the eyes of inheritance tax. Now that has to be done properly, but is often overlooked, and there's no limit on the size of those numbers. If you can demonstrate it's not affecting your quality of life and your income, and you're not diminishing your capital, that would also be exempt. The residential real nil rate band, then the RNRB, that doesn't last forever. That isn't going to exist for everyone all the time. So 175k per person of exemption specifically for the house. If your estate's under £2 million, that's great. You get to keep all of that. If your estate is between 2 million and 2.35 million, you're losing £1 of allowance for every £2. There's effectively a 60% inheritance tax rate there. You are losing half of your allowances as you go. Above 2.35, there's no residency nil rate band lost. So not only have you just spent 350k at 60%, the whole thing is now gone. That can manifest itself in some ways that people might not be expecting as well. Because actually one thing is your allowances and your unused nil rate band and everything might pass to your spouse on death, but that cap of £2 million doesn't. So if all of a sudden you've inherited your spouse's assets and their allowances, your assets may now be above 2 million, whereas they weren't as a couple. So now you'll lose it.
So that can create kind of quite nasty feedback loops in a way. So I gave some examples earlier, £1 million house, and you might, not that you can really modulate the price of the value of your house as such, but you can end up in this bizarre situation where you do, and you want to live in a house that's about that size and value. You've then built assets to live off, including a pension nowadays, but actually, you might have income requirements from the assets you've built, but the assets you built mean that actually your house isn't as inheritance tax free as you thought it was.
No, exactly. And I've got an example of that right now. So the aforementioned £1 million residential property and a £2 million dental business, again, not uncommon that the dental practice might be valued at £2 million these days. I've chosen these numbers quite deliberately, and they're nice round numbers just to illustrate something, but bear with me. So on the face of it, we've got £2 million business covered by business property relief, so there's no inheritance tax there. We've got your 650k, 2 lots of nil rate bands. So when we do talk about inheritance tax for couples, we're often talking about what we call the tax on second death. So we're assuming everything is passed over to the spouse on the death of the first spouse, and we're talking about what happens then. So we'd have 2 lots of 2 lots of nil rate band, 650k, and then of course 350k, 2 lots of residence nil rate band. That covers the house, right? But actually that's not quite right, because of the way the rules work and the order these things happen in. Your business property relief is actually ignored until after that nil rate band is taken away. So you might have £3 million of assets, which on the face of it are not taxable. You are still going to lose your nil rate band. You're going to end up with 140k IHT bill.
Wow. So they kind of do the maths first, apply the countermeasure,
Yeah,
and then give you the reliefs at the end, which might not apply by the time you finish the maths.
It's the size of the pie, not each individual slice in it. So this pie is £3 million of assets. That means you've lost your nil rate band. Oh, but it's okay. We'll actually then we'll apply some BPR. So you're not going to pay tax on that £2 million dental business, but you have lost your nil rate band first. So there's still a tax bill hidden in there that I think many people overlook that bit. It actually gets even worse, because we know the life cycle of a dentist is actually probably to have sold that business long before you would expect to die. And all of a sudden you've turned £2 million of exempt assets into £2 million of other assets, which no longer qualify for business property relief. So all of a sudden your pie now looks like this, and there's over £1 million of it that's taxable. That's going to produce nearly a £500,000 tax bill. Nothing's really changed there. You've swapped one asset for another, probably paid some capital gains tax while you did it as well.
Wow.
So that's it's just an illustration of what happens at £2 million and how painful it can be if you don't know it's coming and you aren't ready for it. I'm going to hand over to David at this point, who's going to start to talk about what's going to happen to pensions from next year. We obviously had BPR limits change last year. We've got pensions changing next year.
Thanks, Si. Hi, everyone. Can everyone see my screen all right?
Yeah.
Good stuff. So some scary figures there from Si, and I'm going to touch on pension changes, and I'm going to simplify it because it is complex and there's lots of nuances and caveats to it. But in real basic terms, what's happening to pensions from April 2027, what's caught and what's not. Capital sums are in and income streams are out. So in terms of capital sums, we want to be thinking about personal pensions. This might be a pension with Vanguard, AJ Bell, Fidelity, where you've been contributing, you've built up a pot, let's say 500,000 or £1 million, or in a SIP, which is effectively the same thing, a self-invested personal pension. If you're currently drawing down from one of those funds, that's included. A SAS is also included, small self-administered scheme, and relevant to the NHS pension, any money purchase additional voluntary contributions, also known as AVCs, are included. So if you've been paying extra into your NHS pension in the form of AVCs, you will have built up a pot of, let's say 50, 100 grand. That is now taken into consideration. What's not taken into consideration is your NHS income pension. So if you were to die and you're receiving an income from the NHS pension, you would then pass a percentage to your spouse. That is not included in these calculations. As well as death and service benefits, anything left to spouse or civil partner, as Si mentioned, that is through the spouse exemption. So if you do have that Vanguard pension that I mentioned, even if it's £1 million, it passes to the spouse free of inheritance tax. as long as they've been nominated, which I'll touch on in a minute. And of course, gifts to charity are still not caught if there's a gift from the pension. There's a lot of edge cases on here and a lot of caveats. So each person's situation is unique. If you're not sure about anything, we're going to be sending an email with booking links to mine and Simon's calendar after this. And if you just want a chat to talk about your situation and your specific pension, then I'm more than happy to do that. This is a really important thing to note, because when there's a change to legislation, it usually compounds and causes other issues that we don't really think about, or at least the government don't really think about. So I want to talk about what happens to a pension on death now. And this is existing legislation before the changes come in place in April 2027. So I've touched on what happens to the NHS pension. A spouse's pension is paid. But those personal pensions, that Vanguard pension that I mentioned of, let's say, £1 million, what happens to that now? Well, if you die before age 75, that passes to the beneficiary completely free of income tax. So we've got that £1 million pension. I die before 75, pass it to my wife. She can access that money completely tax-free. If I die after the age of 75, then she is taxed at her marginal rate, which means if she's a higher rate taxpayer, she'll pay higher rate income tax on that. So she'll pay 40%. Okay, so that's current legislation, and that would be whether it's spouse or whether it's your children that are beneficiaries. One of the most important takeaways from this presentation for me is making sure if you have this type of pension, you have nominated a beneficiary. This is separate to your will. It's easily done with most providers, and it just means the pension trustees know who to pay the money to. You can split that between spouse, let's say 50%, 25% to each child. And as they become more mature, and if you know that you and your spouse are more financially comfortable, you can increase that percentage. So it's just worth noting that. And that comes into financial planning more and more, given what changes are happening. Okay, so that's what the current state of play is, and that continues through April 27. But it has a bigger impact. So if we think about a case study, and I've chosen a £2 million total estate here, if we include the pension specifically, so it's not affected by that taper that Simon's just been through. And we think about a typical client for myself with a main residence of 800,000, savings and ISAs of 100,000, possessions, like car, jewellery of 100,000. So that's £1 million between those three assets there inside the estate, and then personal pensions of £1 million as well. So even though there's a total asset value of 2 million there, before April 27, there's only 1 million inside the estate. So that means with those allowances, the nil rate band and the residence nil rate band, there's no IHT due. But if we look after 27, that £1 million is pulled in, and effectively 40% is taxed on that whole million, which means the inheritance tax charge is £400,000. Again, it's on second death. As I mentioned, when we talk about inheritance tax, it's usually on second death because assets usually pass to spouse and then to the descendants. But this is going to pull more and more people in who are trying to work on the byline, trying to give stuff away to reduce their estate below £1 million. It's just going to pull a lot more people in, and it means that we're going to have to start doing some planning. It actually gets worse, and there's some nasty surprises for people, and most the surprises are going to come to the beneficiaries, because the people whose estate this is, as Ross mentioned, they're detached. They're no longer with us. It's the beneficiaries that are going to have to deal with this. And let's take that case study and say the death of the second partner is after the age of 75. So we've got 400,000 due. Then the beneficiary takes money from the pension after the tax has been paid. Now,
if you're sorry, Dave, because they kind of have to, don't they? Like,
that's it. It's sat there, and there's a few scenarios which I'll talk about where you either take it as a lump sum or you can draw down from it. But yeah, if they want to use the money, that they have to. And if you're over 75, kids are going to be in their 40s or 50s, which means they're likely to be higher rate taxpayers. It could even be additional rate taxpayers, which means it'll be even higher. And this is the part that people aren't really thinking about. So I just saw the note from Jerry. Yeah, I think it is definitely a government swindle. And the reason they brought this legislation in is because the pension was there for retirement income, and people weren't using it as that. It's a tax planning tool to move stuff outside the estate. It benefits your current tax position, but it means that your descendants or beneficiaries can benefit. However, they still, if you live past 75, will have had to pay this type of tax. The difference is when it's stacked, it gets quite scary, and it increases that rate of tax. So if we take all of the money out of the pension at a beneficiary's higher rate of tax, that's an additional 320,000 that your beneficiaries will have to pay. So when you've passed away, it's an incredibly emotional time. There's an emotional burden there. There's a financial burden as well, which actually gets worse because of this income tax we're talking about. But there's also the time and administration of sorting all this out and dealing with the providers, dealing with HMRC, dealing with solicitors, which amplify the whole situation. So if we just think about an inheritance tax bill, which we thought was going to be 400,000, it's actually gone up to 720 on this estate. And as I mentioned, it's a nasty surprise most people don't see coming. Now, I thought I'd just put some FAQs together because I'm sure you've got a lot of questions that you're thinking about. And we've been dealing this with clients since the legislation came out. And I've been dealing with these questions from a lot of people on LinkedIn and also on other social media. Should I empty my pension now? So should I take it all as a lump sum? In most cases, that's not a good idea because you're going to pay probably 45% tax on most of it. And then you might die, and then there's 40% tax, inheritance tax to pay. So it all depends on your situation to what you should do. But it does mean that your income strategy might change. It might mean you take more money from your pension first to try and reduce that burden. And again, that is what HMRC wants, but it's kind of the best of a bad situation, I'd say. Again, it depends on your situation.
I was going to say, yeah, David, it kind of comes quite case specific quite quickly. I think I saw Dan there, who I suspicion I know which Dan we're talking about there. It's like, should you just kind of get rid of it all, which is almost what Simon was alluding to earlier. Like the best way to get rid of your inheritance tax bill is to kind of give everything away. Trouble about the pension, it's really hard because it's kind of so tightly kind of regulated. You can't just give it away, but there's also a tension because you are going to need an income through retirement. So even if theoretically you would want to give everything away, you've got income requirements for your life as a retiree, which shouldn't be overlooked. So there's this massive kind of tension between your capital requirement and the inheritance tax bill, and actually what you're going to need to live off and possible care fees, etc., etc.
Yeah, there's so many variables. We deal with a lot of clients, mutual clients, where we're having this exact issue. They want to reduce their inheritance tax bill, but still want to keep, big income from their assets. And it's just, it's not. You just can't do that. It's a case of you've either got to do a balance or you've got to do it partially. We always encourage gifting early, as long as the children are financially mature and it's going to go to good causes. Might be pay off mortgage, help grandchildren with private education. And that can be difficult for some people. They've built up a lot of wealth over their lifetime, and they've got to have a really strong relationship with money to be able to do that. But it just means that everyone's situation is more unique now than it ever has been, and I don't think that's changing. So, can my children spread withdrawals? We've talked about this briefly, but let's say we've got that £1 million pot again. We pay some inheritance tax on it. That can remain invested, and they can draw down that as income for 20, 30 years if they want to, or they can take it as a lump sum. So that's a common question. Another one, which has not been for a while, but people are asking more and more about annuities. What is an annuity? Well, it was the traditional way to retire. You build up a pot, again, let's use that 1 million, and you buy an annuity, you get an income for life, say 70 grand a year, And that just means, you've got your income, but when you die, you could do a joint annuity as well. So it might be your spouse, but when you both die, then that disappears. Nothing goes to the children. The issue with that strategy is it doesn't really align with our philosophy of, trying to enjoy your life in the early years. Take those families on the multi-generational holidays, spend money while you're still active and you still can. It just takes that flexibility away. Yes, it gives you a bit more certainty, but it means you can't spend when you are the most active. And anyone here who knows their parents, and again, this whole presentation applies to parents as well. I've been speaking to a lot of clients' parents, will know that they don't spend as much money when you get into mid-80s. My grandma certainly doesn't spend too much, and that's the case with most of my clients. So you want to front load that spending. Can my pension pay the whole inheritance tax bill? So I'm going to slightly touch on this now. All of this stuff can get more and more complicated as you dig into it. So I'm going to explain it. Try and stay with me. Let's say we've got that exact same scenario I put through my case study. So we got the £1 million pension, £2 million estate. The pension is half of the estate. It's 50%. Therefore, you can pay 50% of the inheritance tax bill directly from your pension. So that's 200,000. You can ask the pension scheme to pay 200,000 straight to HMRC, and they'll do that. If you need to fund the rest of that money, then you would need to the beneficiary would need to take it as income and pay income tax. So if we talked about the scenario that I put together in the case study, they had 100 grand in savings and ISAs. So they'd use that to pay 100 grand of the bill. The remaining 100,000, they will have had to pull from their pension, which means they wouldn't have taken 100,000 out. They would have to take much more than that to be able to do it. Okay, so that's a common question that I've been asked a lot.
I've got Jerry asking here, David, how do HMRC claim the money? Like if there is illiquid assets, like property, probably a great example. Do they force the sale? What happens if you just don't pay the inheritance tax bill? Probably a bit more of a question for you, Simon, maybe, to be fair, but.
Yeah, well, I'll just touch on that side before you add anything, because it's on one of my next points, Jerry. So really, really good point. And I think this is where a lot of people are going to get stuck, because inheritance tax is due within 6 months, and you're either going to have to force a fire sale on property. And if you've got property in a buy-to-let portfolio, and you've got commercial property in your pension, then you're really going to have to try and find that money from somewhere. So you're going to have to force a sale, potentially pay a discount, or HMRC will just add interest and charges to the inheritance tax if it's not paid within the timeline.
Pretty punitive interest rate.
Yeah, and there are circumstances where inheritance tax bill can be paid in instalments over up to 10 years, I believe, but they still charge you interest. The only thing that really changes is they stop chasing you for it once you've got that agreement. So they still charge you interest. It still has to be paid for somehow. There's maybe one slight silver lining. If the cash that might pay it is in a limited company, then provided that's being paid for by the personal representatives, the people administrating the estate, then any withdrawals via dividend from a company are capped at that 10% or 10.75% basic rate of tax on dividends. So at least that doesn't push up into higher rates, which can be a help, but they're still taxing you to access the money to pay a tax bill.
And it's only qualifying property as well. So certain types of property that qualifies for those instalments.
Yeah.
And if you don't pay the IH2 bill, you can't get the grant of probate, and your beneficiaries do not have the ability to distribute the assets.
Yeah. Yep. So that's going to be a worst case for a lot of people that are heavily invested in property. And it's something that you need to know about in the family. And we're bringing in beneficiaries to this conversation now because there's more weight on them than ever to act when both parents are gone. But it's a consideration that you need to take into place. But yeah, really good question. We've kind of touched on when you'll have to pay the bill within 6 months, and we've kind of touched on liquidity there already. what does this mean for me is the ultimate question. And it goes back to it depends. It really depends on your goals, what you want to do for your kids. If you have children, if you want to give money to charity, what your assets are. There's so many variables now. It's about understanding the playing field is very much what this webinar is about, understanding where you are now. I just saw a note from Dan there about different types of trust. Absolutely, that forms into the planning side, and we are going to touch on some webinars, a two-part webinar on solutions where we'll talk about what the options are and what we've done for a lot of clients. But I think right now the most important thing is understand where you are now and where you'll be post April 27, and also what the knock-on effects of that will be, like that additional income tax that I mentioned, just so then you can really start thinking about, okay, well, this is the size of the problem, then we can start tackling it.
Probably just to elaborate then, bringing kind of two parts together, we had an hour allocated a day, so I feel like we are scratching the surface and only scratching the kind of surface. So it became very clear to us that we had to make sure we covered the kind of the ground rules, and we will be doing a follow-up where there I hesitantly kind of say solutions, but it's more about possible kind of signposts, possible routes, because if you think about it, an individual might have a combination of a residential property, a pension fund, some investment property, possibly some cryptocurrency, possibly some limited companies kind of lurking around that are stuffed full of assets. Each of those requires kind of a holistic plan for each individual and a possible kind of mapping out pathway. I think Dan there kind of actually kind of summed it up quite nicely. Is like, is inheritance tax planning about deciding whether you are saving the maximum possible for the next generation, or is it actually just about saying, well, let's just not worry about it in the slightest and just live our lives? And I'm putting words into Dan's mouth here, but are you just leaving the problem for the beneficiaries and the inheritance tax? And I think it's fairly common to be thinking like that at this moment in time, because we spent probably 3/4 of an hour scratching the surface. Is it just too complicated to kind of take any action on? And I think that's a direct question for both of you, Simon and David. Is it just too complicated? Should we just say stuff it? I won't have to feel the pain of paying it here.
Honestly, I think the answer could be maybe, but you need to know you're doing that. I think either of those approaches is perfectly fine if you've chosen to do it. I think the worst thing that can happen is not knowing the size of the problem you're facing and just walking into the trap. When we're doing this together, the first thing we say is, as you've just said, David, you need to understand the size of the problem you've got. Then you know which levers are available for you to pull to either plan to die with no assets left because you've spent everything and enjoyed life, or to begin to give things away now, or no, you know what, I'm going to leave an IHT bill, inheritance tax bill, for the next generation. Maybe there's a way they will or won't deal with it, but you've known what you're doing.
Yeah, and I think there are some clear solutions for some situations and scenarios. So it's not, I know it's kind of doom and gloom, and this isn't great, this is happening, this double taxation effectively. But there are some simple solutions for some people. We've been doing, I've been setting up some relevant life policies within companies. I don't want to touch too much on the things that we've been doing, because we'll talk about that in the webinar. But there are some straightforward things to do. And the thing that I would always think about, well, what position would I want to be in? Or would I want my children to be in, given that, if I'm not here and my wife's not here? And dealing with the administration, and you might know anyone that's been through this process, even without the complications of dealing with pensions. And I think that's actually another reason, if you've got pensions all over the place, they're going to have to deal with each scheme individually, which is going to be, really hard work. So it's just understanding that and pulling them into the conversation. But going back to my lifestyle financial planning hat, it's about understanding what you really want from life. And if the plan is to spend all the money because you've helped them with private school and they're on their own, then that's fine. But we tailor the plan to whatever that you want to do.
Yeah, Dan is kind of starting to come. I can see he's kind of thinking about it and kind of coming to some conclusions here. And he's talking about is the spending strategy. How much you require at whatever point. that's kind of a key variable which you need to kind of nail down. But I think what David would say, Dan, is that was always a key variable as well. It's just like even more important now, so you can work out. And we're finding this in literal planning exercises, that we're working out what the spending requirement might be at a certain point in time, and it might not be that we give anything away to start with, but there's maybe a phase plan to give elements away, perhaps after 7 years, perhaps placing them in trust if circumstances require that, or direct gifting if it may be. So it does arrive at this kind of intersection of I suppose there's a bit of a feedback loop involved, isn't it? There's often this kind of iteration to it.
Well, it comes back to that diagram at the start of the three kind of experts involved. And you're right, feedback loop is a good way to talk about that, because it's not like any one of those people has the right solution for any part of it. And we'll work together, and it'll evolve as we go before we come up with a solution that fits the client and the family.
And I think that just on that note, I think that's where I found cash flow planning is so useful. The interactive planning with clients, of what we do in our regular annual meetings, is once we've got a clear situation and a strategy, it's those situations of, well, actually, what if instead of spending 80 grand a year for the first 5 years, what if we did 120, because I want to go here, I want to take the whole family here. And we can stress test the plan and say, well, actually, we've got, there is room to do that, or there isn't. And you just get a bit more creative with trying to spend the money you've worked really hard to build on the things that actually mean something to you, which usually for clients is spending your time with who you want, where you want, when you want. That's what it comes down to.
I know it's going to come across kind of hugely rhetorical. Actually, we'll field any more questions. I got a question from Jerry, which I'll actually kind of save for a moment. But although it's rhetorical, we gave a couple of similar-ish kind of case studies as we've gone through this with, large 6 or 7 figures inheritance tax bills. Like, they are solvable, aren't they?
Yeah.
Yeah, definitely. I mean, there's some quick win solutions. It's usually a combination, and it completely depends on your goal. It might be you put some money into a trust for grandchildren's education. You spend more. You give money out of income. All of these things add up together to reduce the liability over time. It goes back to anything. Even if you're planning to exit business, the more time you have, the more options you've got. If you're thinking about this in your 50s and 60s, or even before that, hopefully you've got a few decades, so we can start moving things around if we need to, or spending it, or coming up with a plan.
So I've got a couple of similar-ish kind of questions lurking around, which are essentially kind of asking about, okay, like what do I do as the kind of the first step? How do I get a view on where do I turn first as well? Is it the solicitor? Is it David, yourself as the financial advisor? Is it Simon? How on earth do you kind of make sense of this and navigate your way through?
I think if there's something on the pension side, then just booking a meeting with me and I'll go through that. I think if it's on the wider inheritance tax side, and maybe existing client, speak with Simon. But I think as a starting point, and both of us will be able to put together a calculation of your existing position and your inheritance tax. And then it will be a case of saying, look, this is where you're at. This is what I think we should be looking at. And that may be that we do stuff individually or collaboratively, depending on what your situation is. But I think the driving force would be, if it's more pensions related to start with, then booking with myself, or if it's a wider picture, booking with Simon. What do you think, Simon?
Yeah, agreed. I think there's two main parts to it, aren't there, really? There's understanding what does the estate currently look like, and what might the IHT liability actually be. We've built the tools that will collect and gather that information and help you know that. Jerry, I saw that was kind of one of your questions earlier on. And then there's that cash flow side of it, which you alluded to, David, which is actually what income are these assets generating, what income is required, and what's kind of left to play with to move things around, to start to put things in trust, give them to the next generation, whatever that might be. So we'll flash up some information on screen in a minute, but looking to speak to either of us, and we can get you to that start line of knowing what's the size of the problem today if we don't do anything.
I think the first step, actually, really is quite easy to do, which is a little bit of kind of admin and coordination to work out what's in scope. That
Yeah.
really is quite easy to get to a really good kind of field position quite quickly. What we do afterwards does take a little bit of kind of effort and motivation, I suppose. And I'm not being mean when I say it, but you can always choose to do nothing about this.
Yeah.
And hopefully what we've shown today is we know what the outcome is, and HMRC is the winner, and I never like that to be the case.
Yeah, there is a statistic, and I don't know the actual number, but more often than not, or more often than you'd like, HMRC is the biggest beneficiary of many people's estates, and I don't want that happening.
And also, I forgot to mention before that I've seen that in HMRC are investigating more cases, so they're challenging more inheritance tax. Because it's a declaration, isn't it? A voluntary declaration of assets, and they're asking to see the detail behind people's valuations of assets because they're wanting to, collect more taxes.
So, yeah, Jerry, really easy to take the next step. We'll have contact details on the next slide. We will be reaching out for people. Quite happy to field any final questions if anyone has any. Otherwise, I really thank everyone for viewing today. And apologies that we couldn't cover the entirety of the ground. We knew this was going to happen, but there will be kind of a follow-up to the situation. So I've just had another question. Wouldn't my advisors already be looking at this? Try not to be delicate about it too much, but possibly not, unfortunately. It could just be that this isn't on their radar. They're not thinking about it. It's one of our kind of key philosophies at Hive that we always want to be getting the best outcome, and that means permanently thinking about what people are exposed to years ahead of time, decades in this scenario, hopefully for you, Jerry, as well. We want to get this all totally nailed for you, but possibly not. I mean, I think it's fairly factual. If you haven't been talking about this already, that the pension rule change it's not as if inheritance tax wasn't an issue already with the asset inflation, but the pension is just such a massive marker. I think your advisors should have been talking about it a huge amount already.
Yeah.
Someone else saying,
I think Dan's got a question as well, just about what happens if we've got parents. And this has happened. It happened a couple of weeks ago. I jumped on a video call with some clients of mine, their parents, and I think again it's just a case of having a chat and seeing if we can help them. For some people, it might be that we don't have enough time to do any planning. For others, there is still stuff we can do. So it's definitely worth a conversation. On my side, at least. And again, it just send them the booking link, send them my details. And I think what I do in those type of situations, if you want to be on the call as well, then that's absolutely fine. If they want their privacy, again, that's completely fine.
Yeah, I mean, probably to be fair, similar first step is to understand what the value is and what's in scope, and maybe that kind of triggers some action. I do kind of know how parents can behave sometimes, and they can be a little bit dogmatic from time to time. I'm not saying that always happens, but first step, understand what the lay of the land is, pretty much every set of circumstances. Really appreciate everyone viewing tonight. Thank you very much. I think we'll be sending out recording as well, but we've also got details if people want to make contact on their specific set of circumstances. Appreciate not everyone wants to kind of share specific questions during a webinar. So really appreciate you watching this evening, and thank you very much.
Thank you.
Cheers. Thanks everyone.